As a mother, wife, and divorce attorney for over 15 years, experience has taught me a lot about how to deal with times of uncertainty, transition, and facing opportunities for growth. I'm happy you're joining me for this part of the journey. If you own real estate, you likely have a mortgage. If you're considering divorce, you may be wondering how real estate assets and liabilities get divided in a divorce. My guest here today is an expert in residential lending. And in fact, John Snell is one of the first individuals to be licensed as a certified divorce lending specialist. He's here today to talk with us about how real estate can be used to help negotiate a win-win in a divorce. John, thank you so much for being here.
Thank you, Jennifer, for having me. I love your podcast. You guys do such a great job, and I'm honored that you asked me to be here with you today.
Well, thank you. You know, one of the biggest questions that people have when they're coming into the divorce process is trying to imagine what happens to the mortgage that my name's on. What do we do with the real estate? Do I have to sell it? Can I keep it? And so I just wanted to sit down with you and kind of talk with you about what you've seen in your experience and what options people have. So I think maybe one of the first things we need to just start off talking about is how you got into this. What was your road to helping people with mortgages?
So I entered into the mortgage profession through a corporate layoff, actually, back in 1993. I never would have chosen it, but somehow I was talked into it and found that I really loved helping people with their mortgages. The divorce niche came later, but not a whole lot later. I noticed that so many people that would come to me after divorce had just scars, financial scars, not to mention emotional scars, but and it made it hard a lot of times for them to qualify for that next mortgage. And so I always kind of tucked that back in the back of my head, but actually starting to get proactive about it happened when I met a gentleman by the name of Hal Davis. I don't know if you knew him, remembered him, but he was an attorney in Collin County, and he had a concept called civilized divorce. This was 20 years ago, probably. And back at that point in time, our mortgage licensing was handled by the state of Texas, and they had an exemption for attorneys. So you could get your mortgage license if you were an attorney because you're so smart, right?
Right.
And so Hal had this idea. I love the idea. It was he wanted to have a one-stop shop where he would handle the divorce, and he would also do the refinance that often comes with that when you're trying to take an ex's name off of the original loan or buy them out. But he needed a sponsor a broker to sponsor him. So he was referred to me, and I talked with him a little bit, and I thought this is a win-win for both of us. And the very first transaction we did, I had to do all the work. So I kind of went back to Hal. I said, listen, Hal, I know the commission split I gave you originally. I'm changing the deal.
Yeah.
And but I'm going to invert it. I'm going to keep the lion's share. I'm going to give you a good part of it, but I'm going to continue to do all the work. And he was very thankful, I think, for that opportunity, because he recognized with that very first transaction how much work there goes into getting a mortgage and processing it and packaging it and getting it closed. So that's how I sort of got into the divorce lending niche. Several years later, I became much more intentional about it, and to the point where I go to classes that the attorneys have, CLE classes. I try and go to whatever seminars and luncheons and things like that they had, and so I can learn your business, your side of it, so it makes me a much better lender in the divorce world. And so I love it. It's my passion, and love helping people get through the process.
Well, that's great. And we are definitely going to talk about some of the ways that the home equity can really be used to help facilitate a settlement or a positive outcome. And also the things that people really need to pay attention to, because if it's done incorrectly, that divorce can be a scar that people have to live with for a very, very long time.
Yeah.
Let's back up and talk a little bit about some of the real estate financing basics. So it is not at all uncommon when people come into my office that they say, hey, we own this property. He had it before marriage, or she had it before marriage. And then, my spouse put my name on the deed. And we pull up the records, and in fact, their name's on the deed of trust. So can you help us understand what is the difference between a warranty deed versus a deed of trust?
Okay, so there's really three major documents that happen in every transaction. You've talked about two of them, the deed, the warranty deed, the deed of trust, and then there's also the note. And so how they work, and then all the stuff you sign at closing is
the papers,
filler.
the papers, the papers, the papers.
But those are the three main documents. And so the warranty deed, and there's several different types of deeds, but we'll just be generic. The warranty deed actually is the document that transfers title from one party to another. And so if your client said they were put on the deed, there would actually have to be a deed filed that added him or her to the property, the ownership.
And when we talk about title, I mean, it seems pretty basic, but that's the ownership. That's what gives you the actual right as an owner of the property, is if your name's on the warranty deed.
Correct. And then the deed of trust is the document that secures the lien that gets put on the property, the borrowing. And so that's the bank's document that they use if they need to foreclose on you. It spells out all the conditions, all the requirements that you as a borrower must meet in order to keep ownership of the property. So if you don't meet those requirements, and as my title friends will say, if you don't pay, you don't stay. And so if you don't meet those requirements, then that's the document that the lender will use to foreclose on you. It's also the document, if you at some point in the future pay that loan off, they will use that to release that lien. And so those are the two primary documents. And then the note is your promise to pay that new debt that has been created.
Okay. And so in the note, that's where we'll see the terms like the interest rate and the payment and how it gets paid out. Right?
Correct.
So if your name is on the note, can you just simply take it off the note if your spouse is going to keep the property after divorce?
Despite what some people might say, the answer is probably no.
Right.
And the reality is it used to be possible, but in the last 20 years or more, probably more, all of the loans get packaged up and sold as a security on the secondary mortgage market. And so those investors who buy those loans or the package or buy a share would have expectations that each loan in that package meets a certain criteria. Now you try and take one of the borrowers that you use to qualify out of it, they just can't do it. So realistically, you would only way to get your name off the loan is to either sell the property or refinance it. And that's really kind of where I come in. That's my specialty.
Absolutely. And it's really important in the closing documents and the decree to make sure that that's spelled out. Otherwise, you can't, after it's all done, you can't force the other side to refinance or to sell it.
Right.
It's theirs and your name's on it.
Right.
Now, if I get a divorce and my spouse keeps the property and the mortgage was in both of their names, is that going to hurt me down the road if I want to go get a mortgage, the fact that my name is on that mortgage?
This comes up all the time. I remember giving a presentation once to a group of attorneys, and at the end of the presentation, one attorney actually came up to me, and he's been practicing for 30 years. And he said, "John, I did not realize what you just told us. I get calls from mediations because the one party doesn't believe what they're being told. But the reality is, if your property and the debt get awarded to the other party, then that doesn't count against you when you need to go and buy your next property. There is one caveat to that, and that is you're still obligated in the eyes of the lender, but if you don't make your payments, it will ruin both people's credit. So you got to make sure your ex continues to make the mortgage payments, even though it won't count against you from qualifying on the next house.
So assuming that they stay current on the mortgage and are meeting all of their obligations, it shouldn't necessarily hurt you going forward to get another mortgage.
It doesn't hurt you at all.
Okay. And that's really good to know. But if they are delinquent in the mortgage,
then your credit is going to go down in flames with theirs. One mortgage late can cause your score to go down 100 points. It's quite possible. It depends on what the rest of your credit looks like, but it's a huge hit to your credit. And often lenders will require you to wait a period of time before you can qualify if you've had a late payment on your mortgage.
Right. So I always think it's important to have some kind of recourse built in if they end up defaulting on the note.
And that's your job.
That's right. that's where it helps to have a lawyer who has some experience in this area. What is a deed of trust to secure assumption?
Okay, so going back to the 3 documents I talked about before, those are typically used when you buy a home, refinance a home. You're going to have very similar documents in a divorce case. So you might see a deed of trust to secure assumption that allows the departing spouse to have some recourse against the spouse that's keeping the property.
So like the situation we're just talking about, where the other partner keeps the property and they're on the mortgage, but they're not refinancing it. So your name is still on the note. If they default on that, then you have some recourse.
So that basically then allows you, as the departing spouse, to come back and, in a sense, foreclose on them, take the property back, take control of it, and then you have control of what happens to the property. Unfortunately, by that time, you may be 2-3 payments late because of your ex, and then that really hurts your credit. But that is really the recourse that you have as a departing spouse.
Okay. Now, shifting gears a little bit and talking about the equity. So for a lot of families, the home is their biggest asset, and that's where most of the value is in the estate. How can that equity be used in a divorce to help maybe cash somebody out and get the deal done?
So it's a great asset to have, and the tools that I bring to the table to help get at that asset are through a refinance. And so as you develop your division of the assets and liabilities, that becomes part of it. And typically what I do is one spouse that wants to keep the house has to pay the other spouse their share of the equity, or whatever the agreed upon share is. And that can be done a few different ways. But basically we do a mortgage that would allow that money to be freed up out of the equity of the home and pay it to the departing spouse.
So I want to talk about the different ways that gets accomplished, because this is often something that can be really complicated and confusing to people.
Yeah.
And so let's kind of like boil down what those different options are.
Okay. So generally speaking, there's 3 different ways to do it. The first would be a home equity line of credit. And the home equity lines of credit, that's a home equity loan in the state of Texas. Typically, they have lower costs, but if you already have an underlying mortgage, you're going to have to pay off that underlying mortgage with we call them HELOCs, with the HELOC. And so they're not necessarily a good option, in my opinion, unless you're just borrowing a fairly small amount, your property's free and clear. I think that's a pretty good option for that. One of the reasons they're not great is that they are adjustable. And if you're paying attention to what's happening in the economy now, inflation is just going crazy, and you're going to start seeing these adjustable rates that are home equity lines of credit just go up. So if you have a significant amount of money borrowed on a HELOC, it's going to cost you a lot more going forward.
That's really interesting. So did I understand you correctly to say that you can't access a HELOC if you have an underlying mortgage, or?
Well, you can,
Okay.
but the issue becomes, part of the issue of refinancing is to remove the spouse from the loan. So you have to pay that loan off anyway.
So you're not going to be able to complete the refinance process to remove one of the partners if you've got the mortgage and a HELOC.
You could, but it's just setting up a HELOC in and of itself, I don't think it's a great idea. And that kind of brings me to a second option, which would just be a straight home equity loan, fixed rate. You pay off the existing mortgage. You then can pull cash out of the property, pay it to the ex, and then that's, to me, a lot simpler, especially if you already have a mortgage on the property. I think that's a way to do it.
And is that called that's a cash out refinance?
That's called a cash out refinance. Okay. Some people call it cash back, home equity loan. There's a few different terms out there that people use, but typically cash out refinance.
And once you do a cash out refinance, is it possible in the future to take more cash out of the house if you need it?
You can do that in the future.
Okay.
You have to wait at least 12 months after you've done your first refinance. The downside to a cash out refinance, it's not necessarily a downside, but one factor is that the most you can borrow is 80% of the value. So if you pull all your cash out initially and you wait 12 months, want to do it again, you may not have the equity to access much more than you've already taken out. So that's an issue with home equity loans, cash out loans. The other thing about cash out loans that they tend to have a higher interest rate and higher closing costs than the third option.
This is my favorite.
You're probably leading me to it, right? Which is an OLT lien refinance.
What did you just say?
OLT. We'll spell it for you. OWELTY. Whenever I ask clients if they've ever heard of that term, no. Nobody's ever heard of it. And if you go look the word up in the dictionary, kind of the root of that word is equality. And the concept is to equalize an asset, divide it, partition it, you see that word in your documentation, in a way that an asset typically can't be divided, like a piece of property. You can divide bank accounts pretty easily, property is not. And so that's where the concept of the OLT lien comes in. And how that works is through the divorce process, the settlement, a new lien will be placed on the property, a second lien on the property. And so you'll have your existing mortgage with one of the banks, then you create a second mortgage on that property. And think of it like a pool lien or home improvement. It's the same thing, only the creditor or the benefactor for that second lien, that OLT lien, is going to be the ex-spouse. And so that's how the buyout is able to be taken care of. We create the lien, and then I come back in and refinance it, pay off the current mortgage, and then the OLT lien, and then the spouse gets their buyout proceeds. The OLT liens are going to be a little bit lower rate, a little bit lower fees. And so to me, it's a a better solution than the cash out.
And so when we talk about like the benefits of the OLT, like you just said, lower interest, better terms. And I think the third thing that's really important is you're not capped, right? At that 80-20 loan to value
You're
ratio.
correct. You're correct. So it depends on the type of mortgage that you do, but a conventional loan, you can go up to 95% of the value of the property. And on an FHA loan, you can go up to 97.75%, which that's pretty amazing. VA is only 90%, so I would never put somebody back into a VA type loan, but conventional. So if you're in a situation where you don't have that much equity in the property, you're going to be able to stretch the buyout a lot more with an OLT lien refinance than with a Texas cash out.
Okay, that's great. So we've covered the idea of using a HELOC, the home equity line of credit. We've covered doing the cash out refi and the OLT lien. Now, I would think in the negotiation process, it'd be one thing you'd really want to know is whether the other party or whether you are going to be able to qualify for refinancing. When is a good time to bring in an expert like yourself into the divorce process?
Well, I always say as soon as possible. And so I have a lot of clients that I will meet with before they even file. But certainly, once they've filed, they want to keep the house, or even if they don't want to keep the house, they want to buy a new house when the divorce is settled. It's best to know where you stand as soon as possible, so that way I have the opportunity to create that plan to make it happen for you, whether it's to refinance the house or buy another house. So qualifying there's a lot of issues that come up, potentially. Credit, if I have time to help somebody clean their credit up, that helps to have more time to do that. Also, when you get to the point where you're trying to settle, it might make sense to look at child support, alimony, spousal maintenance, that kind of thing. And that can be structured to even help that person qualify.
So that's sort of the next set of things I want to talk with you about, because we know this, when you talked about the scars of divorce, being able to qualify in the future for another mortgage is really important to people in recovering from divorce. What will a lender look at in terms of income, and what can we do to help people, maximize the settlement so that they can qualify in the future?
Sure. So there's several different sources of income that can be used for qualifying, and just because you receive that income doesn't mean that in our world it's considered qualified income. So you kind of really have to take a look at what you're receiving and is it qualified. So for example, I met with a client last week. Actually, I didn't meet. We talked. I don't meet too much that anymore, but we talked, and she told me she's going to be getting $2,300 a month child support, $3,000 a month for 2 years spousal maintenance, and then she had a part-time job for about a year, making about $1,000 a month. So if you kind of add all that up, you've got like $6,500 or something like that, $6,300 of income. And then I had to painfully go through each one of those and tell her, well, part-time work, you have to have a 2-year track record of it for it to qualify. So she's trying to get a full-time job, which is great. Secondly, the child support. How old are your kids? Well, one is 15 and one's 13. Well, sorry, but you can't get the $2,300 because your child support typically ends when the child turns 18 or graduates from high school. So that income is probably not going to be acceptable to the lender.
How long does the child support have to be paid?
So you have to, for it to be considered qualifying income, you have to have received it for 6 months, and then it has to continue for 3 years, 36 months after the mortgage is closed. Okay. So when you see somebody that's 14, 15, that's going to be an issue in using that for qualified income. I said, well, you can use the income that you'll receive for the second child because they're going to be under that 3-year mark. So that dropped her income to about $1,800 on the child support. And then the spousal maintenance, sorry, you can't use that because it's only lasting for 2 years. So if I were to have been brought in at the beginning of the case, and I was referred to her after mediation, the divorce decree is already in draft form. There's really no way to go back and change that. But I would have suggested maybe not receiving the spousal maintenance $3,000 a month for 2 years. How about $1,500 a month for 4 years? And then it's the same amount of money, but it now stretches that time period out for the receipt of it. Now we can use it for qualifying income. So that's kind of an example of having the ability to brainstorm, consult with somebody on the front end. But going back to your question about income, so generally speaking, we want to see a 2-year track record of employment income for stay-at-home moms. A lot of times they've been out of the workforce for a while, but they need to be back in the workforce for 6 months. It needs to be full-time, W-2, can't be a contractor or in that kind of thing, and can't be part-time. Part-time's okay if you got 2-year track record, but so that's what we're looking for employment income. Alimony, spousal maintenance, child support, pretty much the same guidelines. You have to have received it for 6 months, and then must continue for 3 years after the mortgage is closed.
Okay, so that's really helpful, and I'm just thinking now of all the ways, like many other lawyers, I think of you after the fact, but really to bring you in the early part of the negotiations is really important. One thing that my clients are really worried about is the interest rates. That's such a big part of the mortgage. What are factors that really impact the interest rates? And, you don't have a crystal ball, but, what do you...
I do.
Excellent. What do you
I didn't
see
bring
going
it, but I have one at home. So that's a question I get all the time. Where are interest rates going? And probably for the last decade, we have had all the major real estate economists every single year forecasting rates are going up, rates are going up, rates are going up, and they've been wrong all throughout. I mean, I just pretty much dismiss it, but there's really two different factors that come into play as far as interest rates go. There's the macro level factors, and then there's the micro level factors. So on a macro basis, inflation is the evil enemy of low mortgage rates. So as we see inflation happen, you're going to see mortgage rates go up. It's just a question of how fast. The Federal Reserve over the years has done a really good job of kind of keeping that in check, and they have their tools to make that happen. Recently, they made an announcement that they were going to stop purchasing as many mortgage-backed securities and treasury notes, which that's a signal to the market that rates are going to go up, and so the investors are starting to price that in accordingly. Other macro factors are every month we have reports that come out about employment, inflation type reports, that sort of thing. I always look at the monthly jobs report because that's telling me really the heartbeat of where the economy's going. If you see a strong economy, lots of jobs being created, you're going to see workers who are now more confident about going and looking at other opportunities to increase their income, and that's very inflationary in the economy. So the jobs report every month is a big report I watch. Another thing that we see right now and we've seen is geopolitical type factors. You see last week, I guess, when the new virus spiked, you saw the rates go back down because that's bad news in the world. people tend to move their money, the institutional investors move their money out of stocks into safer havens like the bond market. And so that's good for lower rates. You see Russia looking at Ukraine again. You see China looking at Taiwan. Those are things that create tension and fear in the markets. And so you may start to see the rates tempered and not rise up as fast if something happens there. So that's geopolitical. And then on a micro level, your interest rate, my interest rate is determined by largely how good our credit is. And so that's a huge factor.
And what are the credit numbers that kind of where things break down, or what? And do those, I now know, like with every bank account, it says, get your credit score. Is the credit score I'm looking at as a consumer, is that the same credit score that the lender's going to be looking at?
It is not. So, and I have this conversation almost with every client because everybody is monitoring their credit these days. You have the opportunity, whether your credit was hacked by somebody previously, and the bureaus offer you a free credit monitoring, or most of the credit cards now offer you a monitoring type service. So everybody is monitoring their credit, and so the issue is there are probably 70 different credit scoring models. So the one that you have access to, which is a consumer model, is different than, say, a model that would be used for auto loans or home insurance or even mortgages. So if when it comes time to look at getting a mortgage, the important number is to be what the lender's looking at. So, and I always tell people it's great to have a credit monitoring service just to give you relative numbers. But when it comes time to looking at getting qualified for a mortgage, you want to have a lender pull that credit for you, so you know exactly what the scores are going to look like.
So you don't really know what your score is till a lender pulls it. But then the lender pulling it can have a negative impact. So are there any ways to kind of, know where you're going to stand?
Well, that's not necessarily true.
Okay.
That's a misconception that a lot of people have, that if I'm pulling your credit, your score is going to go down, and everybody thinks it's going to be catastrophic. And the reality is, one credit inquiry from a mortgage company, or any inquiry really, is only going to make a difference of a few points. And so if your credit is already really, really good, it would be totally insignificant. If your credit's really, really bad, it might be the difference between being at one threshold versus dropping down to the next threshold. And so I tell people, you want to know. Yeah. Don't be in fear. If you don't want anybody to pull your credit, you really won't know. And then the other thing is that the credit scoring companies anticipated this, and so, for example, you could have your credit pulled an infinite number of times by mortgage companies within a 30-day period, and that only will count as one inquiry against your credit. Same thing with auto loans. So it's not good to go crazy with that and getting a bunch of new credit cards and all that, but it really isn't as significant as people think it is when it comes time to get a mortgage.
Very good. This has been really helpful as we kind of come to the end of our time, which has just been chock full with so much information and good advice. You've worked with a lot of families who've gone through the divorce process. And I would just like to know, from your vantage point, your experience, what message of hope do you have for somebody who's facing divorce and maybe looking at going through that process?
Well, I'm sure you've gone through tough times. I have. Anybody who's been in the real estate business in 2008 knows what tough times are. But one of the things that has always helped me through tough time is the old adage, this too shall pass. And I think a lot of people, when they're going through divorce, are just so focused on the situation they're in, they can't see it. This too shall pass. This is really painful, but it's only going to be for a period of time, and then I can move on. So this too shall pass is one thing I would say. Another quote I love is by the author Mitch Albom, and he says that all endings are also beginnings. We just don't know it at the time. And so, if I could give anybody encouragement, it's this too shall pass, and now you have your opportunity for a new beginning. And if you focus on the positive, you're going to create a positive outcome. If you focus on the negative, you're going to get a negative outcome. But this is a chance to start over and create the life that you wish you had before. And so, and one other thing about that, Google divorce affirmations.
Really?
There's some amazing information there that can help encourage people.
That's great.
Yeah.
Well, you've given us some really good words to live by, and I think a strong message for people. They need to know they have options, and tapping into that home equity can be a great option in divorce. If you want to learn more information about John Snell, we'll include a link to his website, and we hope that you will look him up. And if you've enjoyed our podcast today, we certainly hope you'll subscribe, and we thank you for your time.